Chapter 4, Part 2, the accrual accounting concepts. Now, in this part, we are going to, after we prepare the adjusting entries for accruals, we're going to describe the nature of an adjusted trial balance, and we're going to carry it through to an income statement, balance sheet, and a statement of retained earnings, and then we're going to close the books. Now, the adjusted trial balance. After we have prepared the adjusting entries and journalized them and posted them into the company records, we then take another trial balance from the ledger after the adjustments were made, and this is called the adjusted trial balance. The purpose here is to prove that the debit balance accounts and the credit balance accounts in the ledger are equal. The adjusted trial balance is the point from which we then prepare the financial statements. Okay, now the adjusting entries in an automated world. This is what we would have with the trial balance. This is how we start. This is before any adjustments. We have recorded all the transactions in up to October 31st. And here we have a trial balance. That's how we ended in Chapter 3. We now realize that what needs to be adjusted are the supplies, the prepaid insurance, perhaps the unearned revenue, and there's been some depreciation on some of the fixed assets like equipment. Those are the adjustments that we have to make. Now what the accountant does, he uses what's called a worksheet. Now this is just a worksheet. This is where he does his work. Here he puts the account titles and he puts the trial balance, debits and credits, debits and credits. Then he works the adjustments. He looks at and he posts the adjustments here on the worksheet and brings it to an adjusted trial balance. Purpose here is to make sure that everything is balanced before we proceed and do an income statement and balance sheet. So here's how we begin. Prepare a trial balance on the worksheet. We take the trial balance, the cash, supplies, prepaid insurance. These are the accounts as at the end of October 31st. No adjustments have been made to them. We then journalize in the general journal the adjusting entries. Debit supplies expense, $1,500. Credit the asset supplies, $1,500. Debit insurance expense, credit prepaid insurance. Debit depreciation expense, credit accumulated depreciation. Debit unearned service revenue, we're reducing that liability, recognize revenue. Journalize the work that's been done but not billed, debit accounts receivable, credit service revenue, interest expense, salaries payable. Those are my adjusting entries. I do them in the general journal. What I do now is I put them in the worksheet. I say, okay, A was a debit down here to salary expense, supplies expense, sorry, $1,500, and a credit to supplies. So I put it in the adjustment columns here. The second one was a debit to insurance expense down here, B, which is 50, and a credit up here to prepaid insurance. Notice I referenced the A's and the B's. C, the journal entry C, was a debit to depreciation expense and a credit to accumulated depreciation. That's a credit balance account. D was a debit to unearned service revenue and a credit to service revenue. Now the next one too, E, was a debit to accounts receivable, and we don't have accounts receivable up there, so we put it down here, accounts receivable, and another credit to service revenue. So you see we have two here, so we leave enough space on the worksheet for that, and so on. Now we total up all the debit balance entries here, 3,440, and we total up all the credit, 3,440. So we know the adjustments are in balance. So the trial balance is balanced, the adjustments are balanced. We've made the adjusted entries. We move it all over to the adjusted trial balance. Now this is interesting. Cash was a debit in the trial balance. There are no adjustments, so it goes as a debit to the adjusted trial balance. Supplies was a debit in the trial balance, you see that? And there's a credit against it in the adjustments. So we subtract that and we carry the 1,000 over to the adjusted trial balance. Same with prepaid insurance. It was debit in the trial balance. There's a $50 credit against it. We subtract that, we carry 550. Equipment, no change, so it's just moved over. Notes payable, no change, move it over. Accounts payable, move it over. Unearned service revenue was a credit in the adjusted trial balance. There's a debit against it in the adjustments, so we subtract it and bring it over here, 800. Common stock, no adjustments. Retained earnings, nothing. Dividends, nothing. Look at service revenue now. We have a credit of 10,000 here, and we have two credits over here. We add them together and we carry the 10,600 over in the credit side of the trial balance, the adjusted trial balance. Salaries expense was 4,000, debit in the trial balance. There's another debit of 1,200 against it in the adjustments. We carry 5,200 in the debit column of the adjusted trial balance. Rent, we just move over. Supplies expense, there was nothing in the trial balance. There's a debit in the adjustments, so we simply move it over as a debit in the adjusted trial balance. Same with insurance expense. Accumulated depreciation, there was nothing here. There was a credit of 40, we move it over and put a credit over here, 40. Depreciation expense, a debit here, we move it over, put a debit there. We follow all the way through here. Salaries payable, nothing down here, a credit of 1,200, we move it over, a credit of 1,200. Now we add up the debits and the credits again, 30,190, 30,190. Don't make the mistake. Some people think this plus this has to equal this. It's not, because it's debit credit. We only look to make sure the debits equal the credits. Here, the debits equal the credits here, or in balance, the debits equal the credits here. You don't add these. You do not add them. People think they make a mistake if they don't add up. That's not the case. Now we know the adjusted trial balance balances. 30,190, 30,190. We are now prepared to do our income statement. And the first thing we do is move over all the income statement accounts, the revenue accounts and the expense accounts. And that's exactly what we do. Revenue in the adjusted trial balance is 10,006. We move it over here, 10,006. Salary expense, that's an expense in the adjusted trial balance of 5,200. We move it over here, 5,200. Rent, 900, 900. Supplies expense, now you don't go back to the trial balance or the adjustments. You simply take it from the adjusted trial balance. If it's a debit in the adjusted trial balance and it is an expense account, you put it in the debit column of the income statement. Insurance expense, a debit in the adjusted trial balance, a debit in the income statement. Accumulated depreciation is a balance sheet account, so we leave that alone. But depreciation expense is a debit in the adjusted trial balance. We make it a debit in the income statement. Interest expense was a debit in the adjusted trial balance. We make it a debit in the income statement. Accounts receivable is balance sheet. Interest payable is balance sheet. Salaries payable is balance sheet. So now we have all the income statement accounts, the revenue and all the expenses. We add them up. They don't balance. Well, good. You see, the revenue account is a credit balance account, and the expense accounts are a debit balance account. If they balance, that would mean we had no profit. Revenue equals expenses. But in this case, the credits are greater than the debits, which means we did have a profit. Now, we move the rest of the accounts over into the balance sheet. Cash was a debit in the adjusted trial balance, debit in the balance sheet. Supplies, 1,000, debit in the adjusted trial balance, a debit in the balance sheet. Prepaid insurance, 550 in the adjusted, 550 in the balance sheet. And so on down. Retained earnings, now we bring, there is no retained earnings. If there was, we'd put it here. This business just got started. Dividends goes to the balance sheet. It was a debit in the adjusted trial balance. It goes to the balance sheet as a debit. Down here, accumulated depreciation was a credit in the adjusted trial balance. It is a credit in the balance sheet. Accounts receivable was a debit in the adjusted trial balance. It's a debit in the balance sheet. Interest payable and salaries payable are moved over. So you check each one of these off, make sure you don't miss an account. Now we total up the debits and the credits, and they don't balance either. Well, yeah, of course not. It wouldn't balance. Because you see, the net income from the income statement hasn't been rolled into the retained earnings yet. So if we are out by the same amount down here in the income statement as we are in the balance sheet, we know everything is going to work. And this is how we figure out our net income. We then subtract. We say, okay, what do we need to bring the debits up to what the credits are? We need 2,860 debit in the income statement. That's our net income. That's what we put down here. Now we go to the balance sheet and we say, okay, what's the difference here? And it's exactly the same amount, which means that once we do the income statement and put it into the retained earnings over here, you know, when you do the retained earnings statement, this side's going to go up by 2,860, which means we are in balance. So we know everything is correct. We can prepare our financial statements. And we have the adjusted trial balance. Now we can do the income statement from the adjusted trial balance, the retained earnings statement, and the balance sheet. We know it's going to work because the worksheet just showed us that it's going to work. All right? So now we just take what we have as the adjusted trial balance. You notice these new accounts down here: salaries, expense, accounts receivable, interest payable, and all that stuff. And we do as we did in chapter 1. We take the revenue accounts and all the expense accounts. We go to the outside column with the revenue. Remember, service revenue to the outside. We total all the expenses. We bring that to the outside. And we have our net income, double underline. Now we do the retained earnings statement. Beginning retained earnings 0. Add the net income, 2,860. Deduct the dividends, and we have retained earnings, 2,360. So there's our income statement and statement of retained earnings. The last thing is the balance sheet. And we put the assets, accounts receivable, supplies, equipment, we move to the inside, less accumulated depreciation. We have 21,910 in assets. When we calculate the liabilities, notes payable, accounts payable, salaries payable, unearned service revenue, remember that, baby? Interest payable, we get total liabilities of that. Our common stock, we knew it was 10. From the retained earnings statement, 2,360, and we balance, and we've prepared. So we journalized the transactions, we post them to the ledger, we adjusted them, and then we prepare the financial statements. Now we have to close the books. The income statements accounts were temporary accounts. They were 0 at the beginning of the year, and at the end of the year we know how much revenue. We have to make them 0 again for the next year. So what the temporary accounts are all the revenue accounts and the expense accounts and the dividends. These were 0 at the beginning of the year, and the total balances they have at the end of the year indicate how much revenue was earned during the year, how much expenses were incurred during the year. Now we have to close them out because we want them back to 0 balance. Now what remains as permanent accounts are the asset, liability, and shareholders' equity. So this is just a trick the accountants do. I mean, they have to do this. I'm going to go through how they do it, but don't worry, I'm not going to ask you on the exam for it. So I mean, listen, don't close your mind just because it's not on the exam. Okay, the revenue accounts, the expense accounts, they are closed to an account called income summary. And then the dividends, income summary is closed to the retained earnings, and dividends is closed to the retained earnings. Now this is rather neat. We do things differently here. Notice what I do is close revenue to income summary. Now revenue had a credit balance. And if I journalize this and I debit revenue and I credit income summary, then when I post this to revenue, it will now have a debit balance and a credit balance of 10,006, so it has a 0 balance. The same with all these expense accounts. They had debit balances in the ledger. And if I make a journal entry, I just make up this journal entry and I credit all those expense accounts. Then if you pictured them as a T, the debit side and the credit side would be the same. And so therefore, it's a zero balance. Okay? Then I close income summary to retain earnings and then dividends to retain earnings. This is how it works. Salary expense was debit 5,200. I'm going to credit it 5,200. I have zero. Supplies expense was 1,500. I'm going to credit it 1,500. So debit 15, credit 15. It's zero. Rent expense, insurance expense, depreciation. Same thing with service revenue. Service revenue had a credit balance of 10,006, but remember in the first journal entry I debited it 10,6, so it has equal debits, equal credits, zero balance. But I transfer this 10,6 to the credit side of income summary, and I transfer all of these expense accounts to the debit side of income summary. Then what do I need to balance income summary? Well, that's my net income, 2,860. So I debit income summary, 2,860, and I credit retained earnings, which means I increase retained earnings by 2,860. Now, dividends had a debit balance, and I credit it to make it zero, and I debit retained earnings. So now the retained earnings adds exactly what it should be, 2,360. And there, I have no longer any revenue accounts. They all have zero balances, and no expense accounts and no dividend accounts. They all have zero balances. And that's the post-closing trial balance. So the accounting cycle. First of all, we analyze business transactions. That's what we're doing in chapters 3. Then we journalize those transactions, again in chapter 3 using the general journal. Then we post to the general ledger, or the ledger, the T accounts. Then we prepare a trial balance of the general ledger. But we know now that there's some transactions that have taken place that we have not recorded. We have to make adjustments like depreciation and unearned revenue we've earned. So in chapter 4, we learn how to journalize and post the adjusting entries. And then once we do that, we come up with what's called the adjusted trial balance, which we know everything is true now. And we prepare our financial statements. Now that's what I would expect from a business student. If you're going on in accounting, and many of you could, you can learn how to journalize and post the closing entries. It's just a technique to bring all the accounts back to zero, so I start the new accounting cycle for the new year. Okay, so that ends part 2 of chapter 4.